Welcome back to Profit Path. Today's the day. Gold is set to continue its ascent. Gold's rally is mainly driven by two key factors. First, its traditional role as a safe investment during economic uncertainty, and secondly, the recent escalation in geopolitical tensions between Russia and Ukraine. In times of trouble, investors often flock to gold, seeing it as a reliable store of value. And with the conflict in Ukraine showing no signs of de-escalation, this trend is likely to continue. But gold's journey to the top isn't solely dependent on geopolitical tensions. The recent surge in long-term bond yields is also playing a part. When bond yields increase, the opportunity cost of holding gold rises, potentially slowing its upward momentum. However, as we've seen, other factors can be even more influential. But let's shift our focus to the stock markets. How have they been performing amidst these broader economic shifts? Well, not so great. Earlier this week, Wall Street ended in the red. Both the Dow Jones Industrial Average and the S&P 500 posted declines of around 0.3%. These losses were primarily driven by ongoing weakness in the manufacturing sectors and those rising bond yields. It's a challenging situation for equities when both the demand and the cost of borrowing on the rise. When manufacturing data weakens, it often signals a broader economic slowdown. The ISM manufacturing PMI has been a key indicator of this. When this index drops below 50, it typically suggests a contraction in the sector. And right now, it's hovering at levels not seen since late 2022. Adding to the woes, rising bond yields exacerbate the problem. It makes borrowing more expensive, which can weigh on corporate profits and economic growth. Now let's look beyond the US. In Asia, Japan's Nikkei slipped by 0.8% as escalating US-China tensions added to worries about the global economy. On the other hand, Hong Kong's Seng bucked the trend, gaining 1.2%. This was mainly due to strength in e-commerce and tech companies. Alibaba shares surged after the company announced share buybacks. While other tech giants also saw gains, it was a mixed bag in Europe, with Germany's DAX underperforming and France's CAC 40 outperforming. As we head into the weekend, all eyes are on Friday's jobs data from the US. The sensitivity around jobs numbers is heightened, given the importance of the labor market in the US economy and the direct impact it has on monetary policy. Analysts are warning of a potential spike in volatility. And it's not just about the numbers, it's also about what they imply for the Fed's next moves. A strong jobs report could reinforce expectations of higher rates for longer, potentially leading to a sell-off in riskier assets. Conversely, a weaker report might spark hopes of a near-term rate cut, leading to a rally. It's a classic risk-on, risk-off dynamic. The looming question is, how will investors respond to Friday's report? What's interesting is that despite these recent rallies in safe haven assets, some strategists remain cautious. Mike Wilson, for example, the chief US equity strategist at Morgan Stanley, he believes that there's still more upside in equities. His reasoning is centered around two key factors: the expectation of rate cuts by the end of the year and the potential for positive earnings growth surprises. However, he acknowledges that getting there might involve some bumps along the way, suggesting that investors should consider buying the dips. So to sum up, gold continues its record run, bond yields are on the rise, and markets are on edge awaiting the jobs report. Will investors move deeper into safe havens, or will data open the door to another rally? Let me know your outlook in the comments. And don't forget to subscribe to Profit Path for timely market coverage. See you back here tomorrow.